Anthony Cambeiro, the president and portfolio manager of Anthology Capital, is with us. Welcome.
Thank you.
Anthony, you're a value investor based in Pennsylvania,
Yep.
Philadelphia. Love to hear about your approach and where you're finding good ideas. Before we do that, can you tell us a little bit about yourself and how you got interested in investing?
Sure. So I first became interested in investing in high school. I remember very vividly, I had been at the dentist and I was flipping through the magazines there, and there was a Financial World magazine, which is no longer in publication, but this was about 93, and on the cover was George Soros. He had just broken the Bank of England, made $1 billion, and I thought, gee, that's pretty interesting. So I read through the magazine, started to get very interested in learning about investing. My father had invested some, so I was going through the newspapers and looking at things. The first book I ever bought was Schwager's The New Market Wizards, which was very interesting because it exposed you to lots of different fund managers' approaches and ways of investing. And so I gobbled that book up and very quickly found an appeal towards looking at stocks, equities, understanding businesses, and understanding how companies operate and how to make money that way. And that's kind of the inception of it. For an early birthday, a 16th birthday, my parents gave me some money in addition to some of the money I had from working, and started investing.
And so give us a sense of your career path so far and what motivated you to start your own firm.
Sure. So in high school, after high school, I decided I wanted to go to Wharton. So I went to Wharton undergrad. And while I was there, I continued to do some investing personally, and got some internships. My first internship was at Prudential Base in the muni bond trading desk, which was not really what I wanted to do, but it was exposure. I got to spend some time living in New York, and a good part of the time I spent there, I actually reached out to a bunch of headhunters in the Philadelphia area, New York area, to try and see if they could find me an internship for the school year and beyond. And after a consistent pestering, one of them finally decided it was open to meeting me. I sat with her it was supposed to only be 30 minutes and ended up being a couple hours, and then she helped me get a job at BlackRock's small cap equity team. And so I spent my junior year, the summer of my junior year, and my senior year there. And then after that, during my senior year, there were not a lot of hedge funds looking to hire that weren't coming and looking to hire undergrads, certainly in the 2001 time frame. So through some connections, I was able to meet the guys at Downtown Associates, the firm where I started. So I got a job there as the fourth person ever hired, a research analyst at basically a long-only concentrated hedge fund in Philadelphia.
And so what motivated you to start your own firm, and tell us a bit about Anthology? There are many ways to invest, and what is your approach?
Sure. So I've been at Downtown for about 10 years. I started there as a research analyst and eventually became co-director of investments and one of the general partners. And the strategy we had there was concentrated long only. We got to do very deep dives on the companies we look to acquire and generally hold them for long periods of time. So I've been there for 10 years. I decided to leave at the beginning of 2011 and set up my own fund. And the reason for that was I'd always wanted to start my own investment business, and I felt that there were some things that could be improved upon and that had a more, I could put my own style. Downtown had been around for 35 years and had a very fixed process and philosophy and strategy, and there were some tweaks to it I felt I could make. So to go into that, the core of Anthology, I'm very much a value investor at heart. I believe all investing in equities, when done properly, is value investing, and growth is a part of value. So I look to hold a core group of stocks long and in a concentrated way, so maybe 10 to 20 securities, and a more diversified group of stocks short. And the differences between the two, the core group of stocks that I hold long are generally high quality businesses. They generate good returns on invested capital, have good capital turns, high margins, hopefully some recurring revenues, and are run by very capable and honest management teams. And I generally look to purchase them during periods of distress. Either the market is acting haywire like in 2008 or 2002 and things are just being indiscriminately sold, or it could be a company specific issue that the market overreacts to because they have a very short-term time horizon, and yet the core problem is not really cut to the competitive advantages of the business. It's very temporary in nature, and it's a matter of trying to figure out what is the nature of the problem that this company is trying to address and face, and do I think they can kind of get past it in the long run. So that's the core long portfolio. The short side is more diversified, and those tend to be more competitively disadvantaged companies, generally found during the process of looking for good longs. They tend to realize that not every company that you look at is great. Some of them are actually quite terrible. And then the other set is frauds and potentially potential frauds, companies that have aggressive accounting and fads and overvalued equities. So.
If we look at the long side of the portfolio first, so give us perhaps some examples of situations where you felt that there was an opportunity for the reasons that you described. So it's very difficult to find a great business with a great manager at a cheaply, trading cheaply. So what are some of the situations you like, and what are some where you really are trying to avoid?
Sure. So would you like a specific example of a company, or? So in one that comes to mind is this company, eGov is the ticker, EGOV. The company's name is NIC USA. And what they do is they build portals for state and local governments. And they are basically granted a monopoly for the state to be the medium by which all interactions with the state online are conducted through this portal. They design the portal, they design all the applications that go on it, and for that they're able to charge some convenience fees. And the business came to my attention in 2003, 2004. I've been doing some work looking for companies that had increasing operating earnings and yet decreasing capital invested in the business. So both sides of both the numerator and denominator on the return on invested capital were moving in the right direction. And so this company came up, and what I found when I looked into it, why the stock had been depressed, is they had come public during the bubble years and had a gigantic market cap, and decided the founder decided to step away. They brought in professional managers who went around and acquired a whole bunch of businesses to grow into their market cap, and when the bubble burst and things fell out, they realized that they bought a bunch of things that weren't doing very well, and so they had some inherited problems they were trying to work through. One was a Secretary of State contract in California, and they had subbed out a bunch of the work, and it had been taking very long, costing them a lot of money. But that was an isolated problem. That was kind of all the rest of the cancer had been excised, and this was the last remaining piece. And the core portal business continued to grow, continued to generate 30+% operating margins and 50-60% returns on invested capital. And so we dug into that to really understand the nature of that business, and the market was focusing on the issues and not realizing that underneath it all there was a very valuable and an interesting business. So we bought the stock in the $4 or $5 range. Over time, the company paid out something on the order of $1.80 in special dividends, and then went up to 12, 13 bucks.
And what is so? Is that very much the reason for these mispricings of great businesses where there is a focus by the market on an issue that you identify as not relevant to the core? What are perhaps some other reasons why great businesses are available at cheap prices?
I mean, I think they're generally, if there wasn't something that the market perceived to be problematic, it might not be at a valuation that was attractive enough. I think you kind of have to have something. Either the market has to misperceive something. Either the problem is the market believes the problem is more serious, or doesn't appreciate the probabilities of outcome, or the market just underappreciates the potential growth opportunity within the business, and it's a matter of just trying to understand the company and figure out if that's the case. That's kind of what we try to do. The core focus of what we try to do is look for situations where the market doesn't fully appreciate what's happening, be it a problem that's more serious or less serious than the market thinks, and or growth prospects and margin prospects that the market doesn't fully appreciate.
What are I guess the key challenges in doing that? It sounds very straightforward, but so what are perhaps some situations where it didn't quite work out as you had expected, or where the temporary problem becomes a bit more prolonged? And
Sure.
Are there any examples of situations that you looked at thinking it was perhaps a temporary problem, but then realized it was actually not, and you decided not to invest?
Sure.
Can you give us a flavor for some of the challenges of applying that?
Yeah, no, it's definitely, I certainly have some scars and wounds of making mistakes. I mean, I think that's the nature of this business. As you learn and you figure out the kinds of problems that exist. One example that comes to mind is a company, Aspect Medical. So this was in the I'm trying to remember, 07, 08, 09 timeframe. This is a company that makes these things called BIS monitors that get applied to the forehead during general surgery. And what it does, it measures the EEG from the brain to determine whether someone is sedated or not, the level of consciousness of the patient. And it was a product that had some level of adoption. I forget what it was, maybe 20% adoption in the market. And the issue that we had identified was that the revenue growth had looked flat because the company had spent or had sold a large number of the monitors themselves, and that had increased revenues. And those revenue streams were falling while the razor blade, the application that you put on the forehead, was growing very rapidly, and those things hadn't crossed over. So revenue growth looked flat, and we felt that the company also had to invest heavily in sales and marketing to kind of get that next push. So the profitability was very muted as well. And we felt that the market wasn't fully appreciating the potential growth that existed should the company be very successful at this. And it just didn't work out exactly as we had hoped. It was much harder convincing anesthesiologists who were on the fence and or who were against it to use this product. So the growth didn't pan out exactly as we had hoped. There was some negative press from a study that was done that got placed in the New England Journal of Medicine that caused the stock to fall quite a bit. We stuck with it given where the valuation was. It traded at very low levels. We had a very close relationship with the management team and had pushed them to rationalizing the business and or selling the company, which they ultimately did to Covidien for around what we paid initially, though we were able to buy some stock at lower levels. But that was one where it didn't really pan out like we had hoped, and was a disappointment for quite a while.
How do you generate your ideas on the long side? What are some of the ways to find these situations? Do you have a database? Give us a sense of that.
So, having been in the business for 10 years and looking at companies, I've probably built up a library of 100-something or more companies that I've spent some meaningful time with and have some idea of what I think the company's worth and where I'd like to buy it. So, in many respects, it's kind of a waiting game to wait for price to come to a level that makes sense. I do a lot of screening to try and find companies that maybe I haven't I looked at before. Looking at the 52-week low list is quite frequently, as well as a number of other screens done based on valuation, based on growth, based on stability of growth, based on a whole range of different factors. There are also some text-specific screens. So within Bloomberg, you can set up alerts that look across all SEC filings, all transcripts, everything, and you can specify specific terms to try and find companies that maybe you wouldn't have seen otherwise. I kind of have a system of looking at any spin-off that comes out and systematically looking through the Form 10 that comes out and that sort of thing. I also I'm on Value Investor Club and Sum Zero, looking for ideas on there. It's sometimes useful to get the initial thesis from someone, so you can kind of cut to what the important parts very quickly. And it's just a lot of reading. I try to get through at least one 10K a day and get through as many company transcripts as I can, trying to find things that just kind of click with my thought process.
What about the magic formula approach? It seems that it would lend itself to your philosophy of finding great businesses cheaply. What do you think of that?
Yeah, I mean, it's a screen I run. I rebuilt it within Bloomberg. I think it can be a good source for ideas. The strategy I have at this stage tends to be much smaller market caps. So some of the ideas that come up, I think Dell has maybe been on there recently. It's not something I would invest in. So I don't blindly follow it, but it's definitely a source, one of the sources for ideas. It's just Joel Greenblatt has done a very good job talking about that strategy, and there's another professor, Wes Gray, in Drexel, who's done some work on the magic formula and the results from that as well that are pretty interesting. But I don't, as much as the phrase says there's a magic formula, I don't know that there really is a magic formula for investing. I think it's the concepts are very simple, the principles are very simple. The difficulty is in having patience and having the discipline to apply those things practically over time. This is a business that can make you feel very humble and make you think that you are wrong right at the time when you actually are about to be right, and it's having the confidence and discipline to stick with things.
And I guess one of the interesting things about the magic formula is that I think is the basket approach, if you will, that one in a way could apply because finding or picking individual companies from that list, as Joel Greenblatt says, it's often very hard because your stomach tends to churn.
Sure.
And you tend to, when you try to cherry pick, you actually may be doing something worse than just taking the whole list. And in a way, I guess where do you focus on there to not make that mistake when you are cherry picking or selecting individual securities? What do you do to not succumb to that danger?
Well, I think by its nature of running a concentrated portfolio of 10 to 20 securities and on average probably 18, I think it is, you're going to run into many situations where you looked at something and you didn't buy it and it went up a lot. And it's as painful as that mistake of omission is, the ones that really to focus on are the mistakes of commission, to avoid buying things that you will end up regretting. And if you can do that over time, you're going to make out just fine. And I think the focus is fundamentally on avoiding mistakes, avoiding buying things that create bigger problems for you down the road than it is on trying to be absolutely perfect and picking the top 2 ideas from that magic formula list or whatever screen that end up looking at. So I think it's it's experience. It's reading through things. It's trying to find things that click and understand. I won't invest in things that I don't feel I understand, and that is understanding the nature of the business, how the company operates, how it makes money, follow a dollar from the income statement through to the balance sheet, and I don't think that I don't think that investing in things that you don't understand the risks is a good philosophy. Now, you can run the magic formula approach and be very diversified, much more so than I think you would in a concentrated way, but I think your best bet is to focus on the things you understand, focus on the things you think have the highest risk reward, and buy them and hold them for a long term.
Some investors would say that the volatility in emerging markets or outside the U.S., generally speaking, tends to favor value investors with the longer term approach, and where these opportunities of great businesses trading cheaply may offer many opportunities to a value investor. Do you look much outside of the U.S.? How do you hunt for opportunities globally?
Sure. So I've looked at some things, and I have some friends that have invested a fair amount in some Japanese nets, and I've looked at some of them. And my issue with it is I think there's still a fair amount of opportunity here in the U.S., and I don't know that I have as deep understanding of the accounting methodologies in other countries, as well as the potential political risks, as well as understanding the mindset of the consumer. And I think that's very important for understanding the business, is what problem that company is solving and why customers buy. So I do look at those things, and it's not to say that I wouldn't invest in anything overseas, but it's got to be a really good and special situation. I haven't found one that I am 100% comfortable with, and also part of that is just the opportunity cost. I'm still finding things to do in the U.S. So,
have you at all looked at Europe then? The crisis there potentially may throw up some dislocations, and have you at all looked at that?
I mean, it's funny. Yeah, so a friend of mine and I have been talking about that last night on running some screens for looking for things like that in Europe, and haven't looked at it yet, but that's something that we're going to be doing here in the next couple weeks. I don't know if we'll find anything that we'll end up being comfortable with, but we'll definitely look there. You have to go where their opportunity exists. I think Mark Faber had, in the book that he wrote, talked about that. Oftentimes during periods where there's a bubble in one area, that means something else is potentially very undervalued, and you kind of have to go where people are not in order to try and find things that will make sense over the intermediate term and longer term.
I guess that would really be true for Japan, where most investors just dismiss it when you mention the word Japan. And I guess you mentioned you did find some interesting things there. What would you look for in Japanese stocks? So
there are some Japanese nets, companies trading less than the net tangible assets, less all liabilities, and I just haven't been comfortable with the whole situation around Japan, with the debt that the country has, and potential issues of what the currency may do. And so many of these Japanese nets are exporters, and if the currency rises, then they may run into trouble. So I've not done anything there. Not to say that it isn't a great idea. I'm sure there'll be several of them that will work out very well. But the other problem in Japan is there's not the same kind of culture with respect to shareholders as there is in the U.S. in terms of maximizing shareholder value, and I think that's why a lot of these things have languished for a number of years. But there's lots of things to do in the world, and you don't have to do them all. You just have to be very good at the things that you choose to do, and that's what we try to do.
To come back to the U.S. then, can you give us example of an investment, perhaps something you have in your portfolio now that you feel is compelling, that best exemplifies your approach on the long side?
Sure. Well, there's two I'll probably talk about. The first one is a company by the name of Orbcomm, ORBC is the ticker, and it's a satellite company. It's about $130, $140 million market cap, but it has $80 million in cash. And what they do is they provide machine-to-machine communication. So, for example, in transportation or in heavy machinery, companies like Caterpillar, which is their largest customer, have devices on their equipment all over the world that relay information back regarding the temperature of the engine, the temperature of the hydraulic fluid, where it's located, all kinds of different information, and that stuff gets sent back to Caterpillar Central so they can monitor this equipment on behalf of their customers as well as on behalf of themselves, since they lease out a large amount of the equipment they sell. So Orbcomm has a constellation of satellites in space that are capturing this information and relaying it. So they're basically the wholesaler of this, and they have today 600,000 subscribers at roughly a $5 average revenue per subscriber per month. And the company, why it has $80 million in cash, is they had launched a bunch of other satellites that ended up not working, and the insurance paid out on it, and so now they're going through the next process of relaunching the next generation of satellites. So the way I think about it is it's a company that has $80 million in cash, earning very little, and they're converting that cash into an income-producing asset that will add a level of improvement on the current generation. So their customers will be able to send bigger packets, bigger messages that will generate more revenues, and they'll be able to handle a lot more customers as well. So the economics of a satellite business are pretty interesting once the satellites are in the air. There's very little incremental operating costs. Every incremental revenue dollar drops 85-90% to the bottom line. They have a fair number of NOLs, so they won't pay cash taxes for a while. And they're right at the cusp of scale. So they already have a large customer base, and it's a matter of providing additional revenue streams to that customer base as well as growing it. Management team bought the company out of bankruptcy. It had initially spent $800-something million building out the ground network, ground stations, as well as the initial launch of satellites, and they were able to buy that out of bankruptcy, and today the company has no debt. So I think over the next 5 years, this is a company that will generate a good amount of cash flow on an operating basis. They're going to put up the satellites, so they'll be investing a lot of capital over the next few years, and then they will be able to grow their EBITDA at a very healthy clip. And at scale, at a maturity, satellite businesses generally will have 3 to 4 turns of debt on their balance sheet. So that's additional liquidity that could come out in the form of special dividends. So we bought the stock around 3. It's a little bit north of that today, and I think over the next several years it's could get up to $7, $8, $9 a share. It just depends on how things grow. And I think what Wall Street doesn't appreciate is the economics of satellite company. I mean, this is a very small business to begin with. It's in many respects, for some people, a micro cap or at best a small cap. And I think Wall Street tends to be very nervous about things like satellites going up in the air and the risk associated with that. And while it certainly would be a setback if SpaceX blows up in launch and a travesty to boot, the company would not be irreparably harmed. It would just delay when they're able to put the next things up. So.
What about the revenue model? Aren't there these contracts where customers pay based on volume or just a fixed fee? How could that work potentially? I'm thinking Caterpillar. If Caterpillar's business goes down, if it's cyclical, let's say in China, would that affect then the revenues for Orbcomm?
So if Caterpillar's manufacturing business goes down, they won't be putting out as many new products. But Orbcomm makes their money on a per month basis. So if the product is out in the field, it's going to be monitored. It's interesting in the case of China and India and Russia, for that matter, Orbcomm can't operate there. The Chinese government does not allow any international satellite company to operate within China. So they actually have no revenues based in China today. Their revenues are all elsewhere around the world. So I don't view China as a risk. It's actually a great opportunity for Orbcomm when and if China opens up. There's a tremendous amount of equipment on the ground that can be lit up right away, and that's potentially very exciting. So the revenue stream is it's both volume based. It's primarily volume based. There may be some subscribers that are on a flat per month basis. Caterpillar is their largest customer. Komatsu is the second largest customer. They are Orbcomm is integrated into several lines within Caterpillar's production system. So when they're going through and building a front-end loader or whatever it might be, they are putting in the Orbcomm equipment in the OEM process rather than aftermarket, and so they're very well integrated. And I don't see there's much in the way of risk from Caterpillar or Komatsu or many of the other guys that are customers today.
You talked about using that cash to launch new satellites up in the air. What is then the competitive advantage, or how can Orbcomm compete versus the is it Inmarsat that's a competitor? Give us a sense of that ground equipment and investment that already went into Orbcomm, and how is it positioned relative to some of these bigger players out there?
So the way that you design your constellation and the nature of it makes a lot of difference. So the Iridium, as an example, is one of the competitors. Iridium has a constellation that is designed for voice. It's very much the ARPUs are much higher. Their cost basis is their cost to operate are much higher. So the way you do a voice network in the satellite is you have to have a dedicated channel open for that period of time that the call is being taken place. And as a result, it becomes very inefficient to do small packets of information over that satellite network. Right? They want to go after the higher ARPU, not the $5 ARPU that and ARPU is average revenue per user that Orbcomm is going after. So Orbcomm's cost structure is much lower, and that's by the design. So they aren't going to be able to do voice. They are very good at machine-to-machine communication, and they've optimized their network for that. So that's one of the primary sources of their advantage. The secondary source of advantage is the ecosystem that's been built around Orbcomm. So there's a number of VARs, value-added resellers, that have built applications that ride on the Orbcomm network. And these are guys that are both focused on heavy machinery and transportation. So things like refrigerated trucks or dry trucks or ships that you're able to provide information back on the temperature, where it's located, the idle time, all kinds of different things that a network operator for that transportation hub would want to know. So those are the kind of two sources, and the fact that they built up all of these assets and the infrastructure at a time when money was very cheap in the late 90s, were able to buy that out of bankruptcy. I think somebody new trying to come in, it would be prohibitively expensive given where Orbcomm is today and the cost to get into it and the potential market opportunity that exists. I think over time, Orbcomm is in a position to probably get up to 2 million subscribers, and each unit in the field would be considered a subscriber. So they're at 600,000 today. So they've penetrated a good portion of the market, and as a result have scale and have low costs, and those things kind of lead to a longer term advantage.
Is there any network effect there? Are these communications just between each unit and the central hub, or potentially among the various units? And could there be a network effect there?
I don't know. I don't think that having I don't think so. Given that there's a latency, that the network isn't to provide. Why I can't do voice is with voice you can't have latency, and with these I think 95% of the messages are within less than 3 minutes, but some messages may take 10 minutes. But this is not stuff that's, you don't need it instantaneously, and so, as a result, I don't know that there's a business case for network to network, machine to machine in the field communication.
What do you think is the major risk to your investment case then?
I think there's definitely some risk to, a weakening global economy will slow things, certainly. I think, the satellites not making it up or not working when they're up would be problematic for a period of time. Those are the kind of the main two risks that I think exist. The company's been able to add on some vertical integration to their business. So as I was describing earlier, the value-added resellers that exist in the ecosystem that exists around the business, they've started to acquire a couple businesses around the transportation market that are value-added resellers. And the reason for that is they wanted to help further the technology of that middle layer between the end application to the customer and the network that Orbcom runs, and really optimize that so that they can provide it to many other VARs that are doing other kinds of applications. If these kinds of acquisitions become distraction and don't pan out, that might be problematic. But I think really, the focus for this investment is a company that is converting cash assets into an income-producing asset and continue to penetrate the market, which is a very large market that exists today for machine-to-machine. If they are able to do that and do that over time, I think the valuation will move up as well, and it will be successful.
You talked earlier about the importance of management. How do you get comfortable in this case, and what's your sense of management?
So I'm a believer in the antiquity philosophy of bridge builders need to stand under the bridges they built, and in the case of these guys, the management team owns 20-something% of the stock. So I think their incentives are very well aligned with shareholders. They think like owners. They're focused on creating long-term shareholder value, and there's only it's very hard to get complete comfort with any management team. There's only so much that they can tell you. So you have to kind of look at their actions, look at the things they've done, and do your best to ensure that your incentives are aligned, or certainly at least that your incentives aren't misaligned. And I think in this case, they're fairly well aligned, and I think they've proven themselves to be pretty adept operators, given where they've taken the business from today.
Did they come on after the bankruptcy?
Yeah, so they acquired the business outside of bankruptcy.
And I guess what is then in the satellite industry overall? Do you find many good capital allocators? There seem to be quite a few bankruptcies there.
Yeah.
Do management teams typically just like to expand? But how is that? How do you think of that?
Well, I think the problem that often happens is they lever up at too early of a stage in their life cycle. They lever up because it's expensive to put things, some of these satellites that are very large, it's expensive to put them up in the air. And with what you have to pay for the satellite, for the rocket, for the insurance, all those things, very expensive. And they tapped the debt markets, and so they were able to get them up in the air, but revenue growth doesn't necessarily come immediately. And so they have a huge debt load, and the revenues aren't there, and that kind of pushes a lot of them into bankruptcy. And I think what appealed to me in this case is the company has no debt today. It's got $80 million in cash. They're going to generate cash over time, and they won't need to tap the debt markets to put this next constellation of satellites in the air. So the risk of bankruptcy seems very remote when you don't have any debt on your books.
What about, and you talked about this a little bit earlier, but if it's cheap to get the financing and other companies recognize this opportunity, and wouldn't it be easy then to just launch a bunch of satellites, and could there be an oversupply of satellites for this particular activity? Is that a risk?
I don't think so. I mean, there's certainly a lot of regulations with respect to the satellites, in respect to the frequencies being used. There are also don't forget the ground infrastructure to be able to get the satellite message that it comes back, so you can relay it to the central hub. And that infrastructure is not cheap to build either. So, a lot of the costs already have been paid for in the case of this company, and a new entrant would be very different. I think that the main sources of competition are the guys who have satellites already up there. Iridium being the main one, Globestar another one. And those guys could potentially come after this market, given that they have satellites up there, even though their networks aren't optimal for it. That's definitely the biggest risk. But like I said, the number of customers that Orbcomm has in this space, as well as the ecosystem of VARs around using their product, I think those are pretty sticky and pretty meaningful advantages that the company has today. So I'm not too worried about a bunch of people running out and trying to put satellites up in the air as a source of competition today.
You also talked earlier about some special situations that you get attracted to, and I'm curious, is there another example of an investment that perhaps highlights that part of your approach?
Sure. So this one kind of sits on the fence between a special situation and what I consider a core long. The company is GSI Technologies, the ticker is GSIT, and they are a manufacturer of SRAM. And SRAM is a cousin to DRAM. DRAM is what you find in all our computers. It's random access memory. And the two markets, though, could not be more dissimilar. So DRAM goes into PCs predominantly. It's very standardized. SRAM, on the other hand, goes into networking equipment and military applications. And it could not be less standardized. There are a wide variety of SRAM products, and in each of those products, very low volumes. So the DRAM market is low number of unit SKUs, low number of different kinds, and wide volume. And as a result, you have wide swings in pricing in the DRAM market. In the SRAM market, the pricing curves are very stable over time, and the life cycle of these products is very long. Their products, GSI has been selling for 10 years. Same product. Not in high volumes, but still gives some indication. The company has been around since '95. It's had 36 consecutive quarters of profitability. They have $90 million in cash. When I acquired it, so that my shares, the company had a market cap of about $120 million. So it had a $30 million enterprise value, doing about 80 to 90 million in revenue. And if you stripped out the legal expenses that they were spending, which I'll get into, the company generated 16 million in EBIT for the last 12 months. So here's a company trading at less than 1 times book value, and less than 2 times EBIT, enterprise value to EBIT. There was not a cheaper stock in the universe, and it had that consecutive string of profitability. So very good track record. Management team owned 25% of the stock, so our incentives were aligned. So the question is, why were you able to buy a stock with these characteristics this cheaply? And it comes back to one thing that I think Wall Street does a very poor job of handicapping, which is litigation. So the company, in June of 2011, was sued by Cypress Semiconductor, the largest competitor. Cypress controls about 40% of the market. It's about a $1 billion market, the SRAM market. GSI is about 10%. And Cypress filed a lawsuit and then filed an ITC lawsuit. They filed a lawsuit in district court and then followed up with a lawsuit in the International Trade Commission. And that was fast-tracked. So that lawsuit basically claimed you had 4 of Cypress's patents and had a number of claims that said that GSI is infringed, and Cypress requested an injunction. the injunction would prevent GSI from importing specific number of products, and also named a bunch of GSI's customers who would then be unable to import those products with GSI's included in it. In total, it's probably about 15% of GSI's revenue. So it isn't the whole company; it's a portion of it. It would hurt if they lose, but it's not the entire thing. And so Cypress sued them. The case went to the ITC. GSI fully believes they haven't infringed on any patents. It's interesting that Cypress has come now to come after GSI. They've been selling these products for 6 years. We think one of the reasons why Cypress has come after them is because the number 2 player in the market, Samsung, has decided to exit the market at the end of this year. Mainly because it's a niche market. Samsung's doing bigger things with cell phones and other things, so they're not focused on it. So 25% of the market is going to be up for grabs at the end of this year. Cypress wanted to create some confusion and create some headache and problem for GSI and the customers as well. And so they launched this lawsuit. It was supposed to be finalized on last Friday or Monday. The judge had either the 27th or the 30th when he was going to announce it. 2 weeks ago, unfortunately, he said that he is too busy, and so he's pushed it off until October, which is what it is. Would have liked it to be cleared up, but we have 3 months before it gets cleared up. And what the market is really good at doing, I think, in many respects, is figuring out the extreme downside that could exist. What they're not good at is figuring out the probabilities. So if you looked at the option market as one area to get a sense for what the market's probability was placing on GSI winning this case, I thought if GSI wins, the stock probably moves up to 8. If they lose, maybe it gets a 3 handle for a period of time, though I don't think longer term it's worth 3. It's probably worth more than that. So if you looked at the $5 strike in September, you could get those for 30 cents, which basically implied, if I'm right about the $8, a 10% probability for GSI winning this case. Like that's not anywhere close to. I don't know what the real probability is, but I'm willing to bet 10% is not the probability. So, this is a company I think that has some really unique growth opportunities once this overhang is past them to grow the business in any case, whether they win or lose. And I expect they will win, and there should be some interesting things happening. So kind of. There's some essence of the business that fits within the core long strategy of high quality company generating great returns on invested capital and cash flows and so forth, and then an element of a special situation that is a little different.
But the investment case is not just tied to the outcome of this litigation, it's also tied to the underlying story, is that right?
Yeah, absolutely. I mean, I think there'll definitely be some short-term pain if they are found to infringe and are unable to import the products. The stock will come down, but I think the market will likely overreact to that, given that it's a low percentage of the revenues, and there are other mitigating factors. Maybe some of them take time. The company can do a new design. There may be potentially a licensing agreement that could be had between them and Cypress, where they pay a royalty. So there are a number of factors that could exist that are not the worst case scenario, even if they lose.
More generally, you talked about how the market often gets this wrong when it comes to litigation. How do you think of litigation in general? Are there any lessons that you can apply to other cases? One that comes to mind is BP and what happened in the Gulf of Mexico. Are there any good ways to conceptualize this approach? Wherever there is litigation, investors tend to just sell and ask questions later. Mm-hmm. How do you approach it? Is there any systematic way that you would approach these litigious situations?
I mean, I wouldn't say that it is. I'm looking at every litigation and trying to get involved. I think the other factors have to fit. It's got to be a business I understand generally and that sort of thing. But I think, I think systematically the market does creates opportunity around litigation, around events that are complicated to understand. Most investors just sell and move on, and that often creates the opportunity. I didn't happen to look into the BP case, but something that's similar to this comes to mind from '03. There was a company, CSG Systems, that was in an arbitration with their largest customer over a contract. And it was very meaningful, 45-50% of revenue. I mean, it was a very meaningful situation. We happened to own the stock. It wasn't my idea at the time. I've only been there a couple of years, but we owned the stock, and CSG lost the arbitration. And the stock immediately fell from 13 or 14 to 9 or 8. And it was a terrible day. But the interesting thing is that from that $8 per share, the company didn't fall apart, and it grew. And I think there are situations where the market feels like losing a case, losing a customer is the end of the world, and in many cases, frequently, it's not. Companies can be good businesses, especially, are far more durable than that. So, I think keeping that in mind is important.
Would you say that then that if we look at for-profit education in the U.S., and I don't know if you looked at that, but would you say that's an extreme case where really most of the revenue is affected, and it's much more core to the underlying business than perhaps in the cases you've given us, and does that make it less attractive?
You know, it's the for-profit space I've spent a little bit of time on. It is a very complicated situation, and anytime you have the government being as large of a customer in many respects for them as it is, you run into a lot of problems. I do not think that the for-profit education space will disappear. They serve a need. They may not generate the same kind of margins and returns on capital that they did in the past, but I don't think the industry itself is going away. There might be some players that fall away, but as a whole, I think the industry will still exist. And whether it's 6 months from now or 12 months from now, we'll probably have a bit more clarity on where things stand. But for the time being, I think it's still a very tough space. They're still trying to figure out how the regulations are changing things, what the effect of the regulations will be, and they're still struggling with enrollment. Certainly, the last few weeks have shown that. So it's a space I'm trying to pay attention to and learn as much as I can about. But I don't think for right now, at least, I'm not actively doing anything there.
In your view, what is the single biggest mistake that investors make?
Well, I think that question is a very difficult one to answer because the mistake depends on the strategy. I think if you were a short-term trader, a big mistake would be holding on to your position, losing positions far too long. That's probably true of many strategies. But I think depending on the investment strategy that you run, the kind of mistake is very different. I think the mistakes that longer-term, value-oriented investors make most frequently is that they have to be right, and and what that means is that they spend a lot of time understanding the business, doing the work necessary to come to a thesis, and there is a subtlety in your brain where you feel like because you've done this work, you must be right. You've spent all this time, and it's very subtle. It's not black and white sunk costs that you can see with numbers. It's psychological, and I think many of the mistakes that are made in investing come down to poor psychology. You are not thinking about things in the right way, or you're letting emotion dictate it, or you're becoming your patience is waning. But it's interesting because sometimes you need to have patience. At other times, if you have too much patience, you're sticking with losers longer than you should, which is also a mistake. So. It's a very tricky game, and that's what makes it so exciting and interesting to be a part of, because it's as much trying to learn about the world as it is learning about yourself. I think there's there's a lot that you learn about yourself during as an investor, how you react to stress, how you react to negative situations, and how you maintain the mental stability to pick yourself up and dust yourself off and keep moving on and looking for the next great idea. It's an industry where you can be made very humble very quickly, and yet you have to have the confidence to know that you can come back and do it again and do it right.
What gives you that confidence, or how have you improved your ability to keep going? And are there any resources, any books, any experiences that have helped you along the way?
Sure. So I think Josh Waitzkin's book, The Art of Learning, is a great book on this score. There's he discusses in the book two theories of intelligence. One is the entity theory, where you are smart and that's why you've done well, which parents often say, well, it's great, you're a winner, you won the game or the match or whatever it might be. And the subtle point is that, well, if I win because I'm a winner, when I lose, I must be a loser. And it's a very brittle philosophy to have, or construct in your mind to have about yourself and your intelligence. Far better is an incremental theory, where it is, I did well because I worked very hard at it and I tried my best. And that's a much more robust philosophy to have, because when negative things happen, and when you run into the fact that there's somebody out there that's probably better than you, you don't fall to pieces. You're able to learn from your experience, learn from the situation, and try and improve. And it's all about improvement. I mean, we're constantly looking to learn and improve, and I think that's kind of the name of the game. I was also watching the Olympics last night, and it's so interesting to watch these athletes who have sacrificed so much in their lives and to get to that stage. And even then they make mistakes, and they don't perform as they could perform for whatever reason. And one of the commentators mentioned Pat Riley as a coach about this after one of the mistakes the U.S. team had made. And so I haven't read the book yet. I went and bought Pat Riley's book, because I think it's going to be very interesting. But it's, how do you have a mental plan when the thunderbolt strikes, when something negative happens? And this happens in the investing world all the time. A company could miss earnings, and before you know it, the stock's marked down 20%. And you're a long-term investor, so any given quarter is not important. But nevertheless, you're going to feel a 20% markdown on a company missing a quarter, even if it didn't have any bearing on the long-term thesis. And so how do you have a plan to recover from those kinds of situations, to keep yourself centered and focused on finding great ideas and making good decisions?
What is the, recommendation from Pat Riley?
I haven't read the book yet. I bought it, but I haven't read it yet. So I'll come back and I'll let you know.
Yeah, we'll follow up.
Yeah.
At a later date. Well, thank you very much for your time.